Schwab Asset Management is proud to support the Inside ETFs podcast. As one of the nation's largest ETF providers, Schwab Asset Management offers insights and perspectives that can help advisors build on their ETF expertise. Did you know that more millennials are choosing ETFs as their investment vehicle of choice? Or that many investors plan to increase their allocation to fixed income, smart beta, and actively managed ETFs? Find out how ETFs can support your clients' goals with Schwab Asset Management's educational resources. Learn more at schwabassetmanagement.com/ETF know-how. Hello and welcome to Inside ETFs, the podcast where we bring the latest and greatest ETF industry perspectives directly to you through in-depth conversations with key thought leaders from across the ETF ecosystem. I'm your host, Douglas Yones, the head of exchange traded products at the New York Stock Exchange, the home of ETFs. Today, I'm joined by Nancy Davis. She is the founder and CIO of Quadratic Capital. Nancy is the portfolio manager for the Quadratic Interest Rate Volatility ETF, ticker symbol IVOL. We'll probably refer to it as IVOL today, and the Quadratic Deflation ETF, which has the ticker symbol BNDD. If you're not familiar with Nancy, she is a regular CNBC contributor, and she has been the recipient of numerous industry recognitions. Barron's named her to their inaugural list of the 100 most influential women in U.S. finance. Institutional Investor called her a rising star of hedge funds. The Hedge Fund Journal tapped her as one of tomorrow's titans. And we call her a close friend of the New York Stock Exchange. Nancy, thank you so much for being here today.
Thanks so much, Doug, for having me.
So let's start a little bit at the beginning. We've known each other for quite some time here, but talk a little bit about your sort of background. How did you end up in this ETF business? Is there a point, or are there spots in your career that you sort of look back at now and you say, that's kind of what led me to where I am today?
It's interesting, even the concept of looking back, because I started my career at Goldman Sachs. I was with the firm for about a decade. And most of that time, I was on the proprietary trading desk. So we were managing Goldman's capital, no outside client money. But I sat right next to, for many years, what was then the program trading desk. And they were right behind me. But I never really did look back and pay attention to what became the ETF business. It used to be they used to trade a lot of sector indices on the derivative desks, and then that moved over to program trading, and that was kind of the start of the sector ETFs. Obviously, SPDR and the index ETF world started first, but I think I was a little late to the game, but I definitely have really come around to think that ETFs are really a fintech technology to be a more tax-efficient mutual fund, and having private funds wrap public securities, I think, is something that I've been very vocal about, that I think it's better for investors for transparency, cheaper fees, and better access using public funds to wrap public securities. It matches the liquidity with the wrapper. So I was a little late, but I am on board and fully embracing ETFs now.
Well, I don't think you relate, because, if anything, the ETF industry continues to grow. Seemingly every year we launch more ETFs than the year before. And certainly with your ETFs, you've brought a lot of institutional-like strategies down to both retail and advisor investors. I want to talk a little bit, if we could, about your firm. Could you give us a bit more information for an advisor that's listening in and they're saying, hey, what's Quadratic Capital? What is your firm all about?
Yeah, so Quadratic's been around almost a decade. The firm was founded in 2013. We run positive convexity strategies in fixed income. And I think really the premise is that prior to having the Quadratic ETFs, investors in fixed income only had negative convexity products, specifically the Barclays Ag, which is now called the Bloomberg Ag. A third of it is mortgages, and mortgages are short volatility because homeowners are long the option to prepay. And so part of really what we're trying to give access to is, instead of investors just being short fixed income volatility from their mortgage exposure, we want to give long volatility exposure. And that's really coming at a really, a lot of things in life are, being in the position and ready at the right time. And I think this is an unprecedented environment with the Fed's balance sheet, specifically the SOMA holdings, which is what the Fed actually bought in the open market through QE. The Fed's balance sheet in the SOMA holdings is over $8.1 trillion, and over 30% of those holdings are mortgages. So it's a very, both of our funds are long interest rate options, therefore long fixed income volatility. And one of our education pieces is just understanding any place that they own any type of structured credit or things that are linked to mortgages, like the ag index, they are only short fixed income volatility.
So I see you on CNBC a lot. I see you as a contributor in so many different places. It seems like the news media loves to tap into you because you are so knowledgeable about so many different parts of the market. And you and your firm really cover a lot of trends, right? You're often forward looking. Are there spots in the market that you look at now and you sort of say, hey, this is a bit of a market trend, and we're going to focus some time, energy, research, what have you, in that place?
Yeah, I think one thing that we're really trying to, stand on my soapbox and get people focused on is how inverted the yield curve is. It's more inverted now than it was even in the late 80s. It's really unprecedented, and often, at least historically, the yield curve, whether it's been a cause or predictor of recession, it has, it's kind of chicken or egg, but it's one of the most inverted yield curves that we've ever seen in the history of financial market derivatives. And that's something I'm trying to explain to investors so they understand the opportunity, because there are not many things you can buy in today's financial markets that are trading below valuation levels from the late 80s, right? It's one of the cheapest asset classes that I've ever seen in my career.
So Nancy, I want to talk a little bit about challenges in the market, and I love to say you're always smiling, so you face challenges with a smile. In fact, and our archivist can call us on this, but I feel like you may have been the last in-person bell ringing before we closed all of that down for COVID. So if you want to talk about someone who goes into a challenging time with a smile, it's Nancy Davis in Quadratic. Could you talk a little bit about what you see in the marketplace? What are the biggest challenges out there as we're sort of closing out on 2022? And are there ways investors should be managing that risk?
Yeah, I think obviously 2022 has been a very stagflationary price movement, with both stocks and bonds selling off together. I think that's it's been one of the worst years for that traditional 60-40 portfolio. So I really think investors need to be thinking about ways to reduce correlation exposures, having that old, my stocks and bonds will be negatively correlated with each other, especially if the Fed is hiking policy rates, but they haven't really, the caps are very small. They haven't really reduced the balance sheet yet. And I do think fixed income volatility is probably going to be moving higher as the balance sheet unwind happens more, especially because we are in a global economy. And the dollar has really appreciated versus the rest of the world. Like, for instance, the Bank of Japan has still been buying bonds. They're still doing QE. The Fed's tightening, and that's made the US really appreciate relative to the rest of the world, which has made our markets more expensive for foreign investors. So I think it's just super important that investors focus on non-correlated assets and adding diversification to their portfolio, and not just doing what's easy, and really looking under the hood and seeing what strategies do and how they could potentially diversify.
Yeah, I want to stay on that topic if I could. We are recording this. We're live at the New York Stock Exchange. One of the primary headlines, I think, all year has really been a discussion about the Fed, in particular, rising rates and a rising rates environment. How do you see things right now?
Well, the market is very confident that the Fed hiking policy rates is going to ease future inflation. So I'd say the one consensus that is out there is that inflation expectations are priced to dramatically fall. The last CPI print, we have another one coming out next week, as well as the Fed's December rate hike. It was 7.7. It was cheered by the market as a bullish indicator, but the future inflation expectations are all right around 2% for CPI inflation, and the yield curve is one of its most negative ever in the history of financial markets. So the market is really priced for this kind of ease of future inflation, as well as price for a recession. And I think that could really be the surprise in 23, is that the market could step back and say, look, the Fed hiking policy rates isn't going to put more truck drivers on the road, or it's not going to make Russia not invade Ukraine, or it's not going to ease up on the supply side disruptions. So I do think inflation expectations in the future are very complacent that the Fed hiking policy rates, we've seen peak inflation, it's going to be falling dramatically, and it's really priced in. And that's what I like to focus on with investors, is it's not what do you think is going to happen, it's what's priced into the market.
So is that where your ETF IVOL fits in?
Yeah, so IVOL accesses inflation protection strategies. We use TIPS, which are Treasury inflation protected securities, plus interest rate options on the yield curve. So it benefits as right now the difference between short and long dated rates is negative, meaning, an investor gets paid less yield to own a longer dated bond, thinking of it as lending money to the US for a lower interest rate in the future. And so we benefit from either less Fed hikes or even Fed cuts, or higher long-term yields with the options piece, which helps solve the duration problem with TIPS. I think that's one of the challenges with TIPS by themselves, is they are bonds, they are treasuries, and they will lose money based on their duration. And inflation is a very risky asset class. There isn't a zero with inflation. It can go, break evens can go negative. There is no zero bound. And so we find using the fully funded interest rate options is a nice potential diversifier to help investors be long fixed income vol, which we think is really timely given the quantitative tightening with the Fed's balance sheet.
And as a reminder, you can find a lot of information about Nancy's ETFs, including IVOL. You go to etfcentral.com, easy to remember, ETF Central. Type in the screener IVOL, it'll pop right up. You can learn everything about her ETF. Nancy, for an advisor who's maybe not as familiar with your ETF, how should they be thinking about them? When we're talking a lot about portfolio construction, where does it all fit in?
Yeah, so IVOL has paid a minimum monthly distribution of 30 basis points. We don't take corporate credit spread risk. Most investors in bonds, they add credit spread risk to interest rate risk, whether it's high yield, investment grade, levered loans, floating rate notes, all those things want credit spreads to tighten. We use interest rate spreads. So it's just a different type of spread risk, which is why historically it's had extremely low correlation to equities and to credit, as well as to the ag. So it's just a different type of spread risk. I think of it as almost like an opposite of a mortgage. If you think about a mortgage, with mortgages, you want interest rate volatility to fall because you're short options to homeowners at prepayment risk. And then you want yields, long dated yields to go lower. For us, we want long dated yields to go higher or short dated yields to go lower, as well as real yields to go lower because we're long inflation protected bonds.
Yeah, one of the things as we've gotten to know each other over the years that I'm always fascinated by is you think in a holistic terms, right? A lot of what we've talked about during the podcast is, a person's individual finances and total wealth picture. So you're bringing into house ownership, mortgages, and a lot of times we tend not to think about that. We think only about, let's say, the super liquid parts of a portfolio. And so I love watching a lot of your media and a lot of the work you do, because you do take this bigger picture. If there's an advisor out there and they're saying, hey, I want to learn more. You've touched on some really interesting topics, but I need to get deeper. All right. And I really want to get into your strategies and I'm thinking about adding it to the portfolio. How do I do it? Like, how do they connect with you? What's the best approach?
Well, we have our fund website, which is probably the first, stepping stone. That is IVOLETF.com. There's a lot of articles, materials, information about the fund. There's also a contact us page. So we're happy to set up calls to explain the strategy. It is definitely, I think, the largest asset class in the world is the interest rate markets. It's approximately 5 times bigger than the stock market. And I think this is really the time for investors to be looking at the New York Stock Exchange for these innovative strategies that can access asset classes like the rates market. Most professional real estate investors will hedge their rate risk, whereas most regular people don't. And so that's, I think, been part of the joy of our partnership with the New York Stock Exchange, is being able to access the interest rate markets for everyone, and providing that that traditionally institutional product to. We have a lot of institutional investors, and we also have wealth managers and endowments. It's a very diverse client base, but I think that Q-sipping, so to speak, taking in and making an investable asset class has been really an innovation and a nice diversifier potentially for investors.
And of course, we're recording this during the holiday season. We think a lot about gifts and gift giving. Certainly one of the biggest gifts that ETF have given us is being able to take these types of investment solutions that, Nancy, you and your firm have been providing through Quadratic for quite some time, and being able to wrap them up and provide them directly to advisors, directly to investors, whereas in the past, they just frankly wouldn't have had access. I invite all of our listeners again to either follow Nancy Davis on any social media platform, but of course, visit her website. That was IVOLETF.com, IVOLETF.com. And please engage with her and her team. She puts out a lot of really great information and materials on the market. That is a wrap on this edition of the Inside ETFs podcast. As a reminder, you can find this episode as well as many other episodes of this podcast on the New York Stock Exchange's website, etfcentral.com. I want to thank you again, Nancy, for not only being a friend, but being here to take your time to share your insights. Please stay tuned for upcoming episodes featuring thought leaders from across the ETF ecosystem. I'm Douglas Yones, head of exchange traded funds at the New York Stock Exchange, the home of ETFs. Schwab Asset Management is proud to support the Inside ETFs podcast. As one of the nation's largest ETF providers, Schwab Asset Management offers insights and perspectives that can help advisors build on their ETF expertise. Did you know that more millennials are choosing ETFs as their investment vehicle of choice, or that many investors plan to increase their allocation to fixed income, smart beta, and actively managed ETFs? Find out how ETFs can support your clients' goals with Schwab Asset Management's educational resources. Learn more at schwabassetmanagement.com/ETF know-how.